We are Group 6, and today we are presenting our financial statement analysis for NVIDIA Corporation. Our bottom line, we rate NVIDIA a buy. Our investment thesis rests on two pillars: NVIDIA's dominance in AI infrastructure through its CUDA software ecosystem, and strong financial position sustaining growing revenues and gross margins above 70%. Key risks include export controls to China, margin pressures from the Blackwell ramp, and customer concentration. NVIDIA is a semiconductor designer of designs, GPUs, and AI platforms that outsources all manufacturing primarily to TSMC. Its data center segment represents 90% of revenue. NVIDIA's strategic differentiator is CUDA, a proprietary computing platform embedded in millions of developer environments, creating very high switching costs. Additionally, the AI chip market is projected to reach 600 billion by 2033, with GPUs retaining over 80% market share. NVIDIA reports under US GAAP with a fiscal year ending in late January. Its auditor, Pricewaterhouse, issued an unqualified opinion, meaning there are no material weaknesses. The most notable accounting item is the 4.5 billion H20 inventory write-down due to a lower China demand after export controls, which had a 2.6% impact on gross margin.
Management expresses confidence in continued demand backed by 95.2 billion in supply commitments. The key near-term headwind is H20 China exports, which were excluded from next quarter guidance. On ESG, NVIDIA publishes a corporate responsibility report where power efficiency is becoming a strategic differentiator as main customers evaluate performance per watt. The main income statement takeaway is that revenue grew from 61 billion to 216 billion, a 3.5 times increase in 3 years. The slight gross margin compression from 75% to 71% reflects its new data center solution Blackwell ramp costs and the mentioned inventory write-down. The balance sheet reflects financial strength. Total assets more than tripled to 207 billion, while equity grew 3.6 times, funded primarily by retained earnings, while long-term debt as a percentage of assets fell from 13% to just 3.6%. Additionally, the company has 62 billion on liquid assets. NVIDIA's profitability ratios are exceptional relative to peers. Gross margin of 71%, net margin of 55.6%, and return on equity of 76% are best in class compared to its peers. On liquidity, the current ratio of 3.9 and quick ratio of 3.2 are well ahead of peers, while debt to equity is just 0.1 times, a conservative capital structure that gives NVIDIA significant flexibility.
Collections from customers are aligned with the industry for 65 days. NVIDIA's high cash conversion cycle of 133 days is due to a strategic choice. NVIDIA pre-positions inventory and pays premiums to secure supply ahead of demand. The risk of this approach is demanding forecasting errors that can turn into inventory write-offs. Operating cash flow grew at 91% compounded annual growth rate, closely aligned with net income growth, which reflects high earnings quality. Investing cash flows reflect at 73 billion in marketable securities over 3 years. On financing, NVIDIA returned 83.3 billion through share buybacks across the period analyzed, coupled with sustained business growth, a strong signal of management's confidence in the company's long-term value. NVIDIA stock has delivered over 1,300% from early 2023 to its all-time high of $212.19 in October 2025, despite last year's January volatility due to DeepSeek's new product launch. As of March 2026, NVIDIA trades near its 200-day moving average, a level that has historically represented long-term trend support. Our recommendation is to buy. NVIDIA's outstanding financial position and unmatched AI infrastructure creates an opportunity to become the market leader through a structural shift toward AI accelerated computing. Risks like export controls, margin transition, and customer concentration are real but manageable for an investor with a 5 to 10 year horizon. Thank you very much.